Imagine this. You take a trade. The setup looks perfect. The trend is clear. Everything makes sense. But suddenly, price spikes, hits your stop loss, and then moves exactly in the direction you predicted. Sound familiar? That's not bad luck. That's how the market works. The market isn't controlled by retail traders. It's controlled by large institutions, banks, and hedge funds. And these institutions need something to move the market: liquidity. The trading concepts we'll discuss today come from the methodology taught by Michael J. Huddleston, commonly known as ICT. Most beginner traders make the same mistake. They buy breakouts. They place stop losses in obvious places, and they follow the crowd. But institutions know exactly where those stop losses are. When price forms equal highs or equal lows, it creates a liquidity pool. Why? Because many traders place stop losses in the same area. Institutions often push price toward these zones to trigger those stops before making the real move. To understand where the market is going, traders look at market structure. An uptrend forms, higher highs and higher lows. A downtrend forms, lower highs and lower lows. But the most important moment is when this structure breaks. When price breaks a major structure level, it's called a break of structure, or BOS. This tells us that smart money may be shifting the direction of the market. Another key ICT concept is the order block. An order block is the final candle before a strong move in the market. This area represents where institutions placed large orders. And interestingly, price often returns to these areas later.
When institutions move the market quickly, they often leave behind unfilled orders. So later, price returns to those areas. When the market moves extremely fast, it creates something called a fair value gap. This is an imbalance between buyers and sellers, and the market often comes back to fill this gap before continuing the move. Here's how professional traders combine everything. First, price sweeps liquidity. Then, the market breaks structure. Next, an order block forms. Finally, price retraces into a fair value gap. That's where traders look for entries. Look at this example. Price grabs liquidity above equal highs. Then it breaks structure and drops. Price returns to the order block and fair value gap. And then the move continues downward. The biggest lesson in ICT trading is simple. The market isn't random. It moves from liquidity to liquidity. And once you understand where institutions need to move price, trading becomes much clearer. Stop chasing the market. Start understanding how smart money actually trades. Because once you see liquidity, order blocks, and fair value gaps, you'll never look at a chart the same way again.